the newer variants out there. And a wild story with Cassava Sciences here. Those shares down 20% here in pre-market trade. Remember, last year they came out with data showing what appeared to be a major breakthrough in treatment for Alzheimer's disease. A bombshell story in the New York Times now calling a lot of that data into question here, saying that several medical journals have actually retracted the study that actually led to the big rally in the shares. There was a similar story by the Wall Street Journal a few months ago that also made some allegations about the veracity of that data. Keep an eye on that space. Those shares had been a retail stock darling. You flip it up here, John, we are going to take a look, of course, at Netflix after the bell on the Bloomberg markets to close. Those shares basically flat on the day. You called it an awful stock here. Keep in mind, this is like the fourth worst performer, in the S&P 500, third worst in the NASDAQ 100 on a year-to-date basis. And a lot of that stems from the report that we got back in January where the company came out, said it only expects, Tom, to add about 2.5 million subscribers for the first quarter here. That's about a third fewer than what the street was looking for here. It'll be interesting to see not only with regards to the subscriber growth, but also, of course, with the company's pricing power. Tom, Bloomberg Intelligence actually had some great data on app downloads for a lot of these streaming services, and it showed a pretty healthy environment, but just not for Netflix,
so what
not for Warner Brothers, not for Disney.
What does Netflix mean for Warner Brothers? Zaslav is out doing the road show right now. What does the Netflix release this afternoon mean for Warner Brothers Discovery?
It's going to mean, well, let me just quote Bloomberg Intelligence for you, Tom. The streaming services that are doing better right now are the non-subscription streaming services, the ones that are more reliant on advertising rather than on the price of the subscription itself. It's the ones that are subscription related, like Netflix, like Disney, and like the new Warner Brothers Discovery that are suffering the most.
It'll be interesting this afternoon with Netflix to close. Romain Vostok there. This is a joy because he's been so right about the resilient dollar. Dollar's going to die. Dollar's going to be weak. And Mark McCormick of TD Security said, no, it's not. As global head of foreign exchange strategy, Mr. McCormick writes one of the most nuanced research pieces on the street. Mark, I'm going to go to factor analysis. You have 6 factors that matter within your soup, your cocktail, if you will, of strategy. Tell me where growth fits in now and what growth differentials say for the Japanese government.
Well, thanks, you. Yeah, it's great. What's quite interesting is if you think about growth, it's kind of what was forgotten about. In 2021, it was all about central bank divergence, who's hiking, who's moving forward, who has to respond to inflation. Everyone kind of forgot about growth. What we're seeing is if we look at growth momentum as a factor, it is one of the best performing strategies year to date, along with terms of trade, carry, and even equity divergence. So what you're seeing is across many countries, a divergence theme is happening across multiple factors, which is quite important because this isn't just about the Fed. It's not just about central banks. Right. Especially in the currency market, we're thinking about how important relative growth divergence matters, and that's going to be a big driver, I think, as we move toward 2022.
And we've got Gershay at the IMF out with the IMF report this morning, and he's going to talk a lot about trade. Full trade in Shanghai into the weakness or the potential weakness of EM.
Well, I think in terms of, if you think about where growth is, like what we still have is the services reopening that's coming in EM. And what I think is a big driver for this year is if you think about it, the G4 central bank balance sheet shrinking, but China's credit impulse is rising. So on net, the credit cycle is kind of turning in delta terms, but it's still generally positive. So it changes the landscape of which currencies can outperform others. So if you were to think about what happened this year, we had a massive sell-off in equities. We've seen deterioration in Sharpe ratios. And the best performing currencies year to date are in Latin America. They're emerging markets, they're high yield, they're carry currencies. So there's still an element here that if we still have the positive commodity story, we still have the carry story, we still have growth divergence, we don't need a unified, strong dollar. So there's still elements here that China stimulating is still good for pockets of the world because it is pushing capital flows on the equity side out of the United States back into other countries.
Is the narrative clearer now, Mark? Has basically uncertainty about the direction of certain currencies been somewhat removed?
Yeah, I think it's clear because if you think about it in terms of like the market narrative, we had conversations with clients in January where we really liked Aussie yen. It was one of our favorite trades to start the year. There was a lot of skepticism that Aussie yen could rally given the uncertainty around Russia, the global economy. And what we had kind of disentangled is that if you look at the 2 factors that were driving Aussie yen, it wasn't risk. It was commodities and it was yields. And so I think part of what we know that is the market is aware of now is this commodity theme, this terms of trade theme This is really a prevailing narrative along with the central bank policy. So I think like talking about growth again and talking about valuations and talking about equities is very critical, where the biggest thing that we've seen this year is real rates have gone up 100 basis points in the US. This is what is causing the new narrative shift, which is kind of a pivot back to Europe. And I think that's what's very clear in the FX market is we know yields are rising. We know which central banks were hawkish last year. We know which ones will likely be less hawkish this year. And we're starting to see these new trades emerge, which I think a big part of it's going to be a divergence across Europe. Euro, sterling, Swiss, stocky, all those currencies are now in play, I think, for the second half of the year.
And how much do you expect the dollar to weaken, just broadly, considering the fact that people have baked in what you see already as being the main and, frankly, staying narrative?
Right. So I'd say we're in still the point of period of time here where the dollar strengthens. It's through Q2. I think Euro's still kind of holding it around 108, but you could see some of these EMs start to crater a little bit on the hawkish rates. And, part of what the Fed needs to do is tighten financial conditions. And they haven't really done that too much yet. So there's still, we still need to see real rates rise a little bit, maybe another 25 basis points. That is disruptive for U.S. equities. That is what causes a lot of the turbulence we're seeing in markets. On the other side of this, however, if the Fed disrupts the golden goose that has supported the dollar for the last couple of years, it is really the equity flows into the U.S. that have offset the current account deficit. So if we think about this rotation, Euro can revisit 115 to 120, especially as ECB is probably going to hike rates twice this year. But it's too early to sequence ECB tightening because the other factors that we're tracking for the Euro, the ones we had already mentioned, growth, terms of trade, carry, they're still negative in our framework. So we're not buying the Euro because there's not a broad-based conviction for it. But when it happens, Euro bottoming out around 108, 107, kind of where we're at now, there's significant upside probably to 120 to start next year. And I would even say if you're really kind of focused on the changes around what's happening in Europe, Euro Swiss is a prime candidate right now. It's held in around parity. It's held in at 101. And most of our models are pointing towards Euro Swiss towards about 104, even in the next couple of weeks.
There is nothing boring about foreign exchange right now, that's for sure. Mark McCormick at TD Securities. Thank you, sir, as always. Nothing boring about the commodity market either. So earlier today, we heard from the French Finance Minister, Bruno Le Maire, and he said it's necessary, quote, more than ever to stop oil imports from Russia.
Yeah.
France hopes to convince European Union partners in the coming weeks of this. In an interview a little bit earlier today, here's the number from JP Morgan. If the EU banned all Russian oil immediately, Tom, crude, in their view, may hit 185.
And John, what's important here is the partition in that article between gas, net gas, and oil. Americans don't make that partition enough.
And the time frame for doing this.
Yeah.
An immediate ban on Russian oil. Could see crude at 185. That's the view from JP Morgan. A big view, too. 106.98 on WTI this morning. Good morning to you all worldwide. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. In Ukraine, President Volodymyr Zelensky says a long-anticipated Russian offensive has begun. Russian forces are said to be targeting the Donbass region in the eastern part of the country. The assault is taking place along a front of more than 300 miles. It's a fresh blow to Russia's billionaires. President Vladimir Putin has dropped the curtain on the era of foreign stock listings. Putin has signed off on legal amendments that require Russian companies to delist their overseas shares. That could force tycoons such as Vladimir Putin to reconfigure the structure of businesses they hold via overseas shares, paying foreign currency dividends. In China, the central bank is promising to help businesses hurt by recent COVID outbreaks and the lockdowns. Measures include general pledges for more credit and other financial support. The People's Bank of China is also urging lenders to boost help for industries such as tourism, catering, and retail. And investors are rapidly getting out of stocks. Last week, U.S. equities saw their biggest weekly outflows of the year. Investors pulled a net $15.5 billion out of U.S. equity funds. That's according to Bank of America. Meanwhile, European funds experienced a ninth straight week of outflows. Bloomberg's learned that cryptocurrency startup Blockchain.com is planning an IPO that could take place this year. The company is currently interviewing banks. In March, Blockchain.com said that a funding round valued it at $14 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front row, the best seats in the house for business's greatest minds.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I would point out that the 1994 cycle, where we raised the policy rate 300 basis points in a year, in that cycle, there was a 75 basis point increase at one point. So I wouldn't rule it out, but it's not my base case here.
This at the moment is the biggest non-story. Jim Bullard of the St. Louis Fed. Can I read the last line out?
Please.
I wouldn't rule it out, but it's not my base case. I mean, he's not ruling anything out, but it's not his base. Ultimately, his base case is 50 basis points. May 4th, I'll see you there, Tom. May 4th for the Fed. I mean, why do we get excited about these things?
Can I break in for a second? Because Sebastian Gailey of Nordea
He's getting excited about this
He got
too.
excited about it.
Okay.
He put out a note just
Okay.
not long ago saying it's hard not to fixate on comments from Bullard suggesting a 75 basis point rate hike is not off the table for good reason. It's because right now people are really understanding the Fed has not gotten the conversation around inflation under control. And so how much do they need to do to shock the market? I think that concept is sort of rattling
Well, I
the
think the
market.
more interesting thing about Jim Bullard's communication is the fact he wants perhaps a 3 handle by year end.
3.5.
On Fed funds.
Agreed.
That's the story for Jim Bullard. If he was leading the committee, Tom, then maybe his base case would be something other than 50 basis points, but he's not.
Right.
So trying to get the committee to move 75 on May 4th is just not part of the
we
conversation,
need
is
to
it?
frame this, John. It's really important. We need to stop the show. And I got to be honest here. Mr. Bullard does not welcome me at the St. Louis Cardinals box seats that he has. He's there at every game. But he and I are quite close. John, this is a guy who wrote about regime change in a modern theory, which the Fed has almost stumbled into. We're in a regime change, and in his own way, he's leading the discussion a la Dudley, but in a different way.
He sent me some shredded money from the Money Museum at the
Did
St.
he?
Louis
Yes,
Fed.
I've been there.
Yeah.
It's very good.
Thank you for that, Jim Bullard.
Very good.
I'm not sure what the message underpinning that particular
The
gift
message
was.
is I need to eat at Mike Schmidt's place right outside the park and
Are
see
you trying to make a
Cardinals
trip? Is that what you're trying to do?
road trip Cardinals game with Mr. Bullock.
I'm down for that one.
Let's do this. Let's move on from 75 basis points to 75 people standing in line at TSA. Kriti Gupta provides wisdom.
Yeah, we got to talk about the mask mandate. That seems to be the headline this morning. After you have a mask mandate dropped after a federal judge has basically overturned that ruling, saying that in public places, whether it comes to metro lines, when it comes to airlines, whether it even comes to your Uber rides, you no longer have to wear a mask. Now, that's really important when it comes to the airline industry, which has been lobbying more and more for the Biden administration to actually push and drop this mandate. It also comes after the CDC extended that mandate to May 3rd. So my chart of the day here actually puts that into perspective with the TSA checkpoint throughput. Now, that's a lot of fancy words for how many passengers are flying through the airline industry in the United States. And you can see we're nearly back to pre-pandemic levels. The hiccup here is how's that actually affecting airline stock? Because if you were to hypothetically overlay an airline chart for the industry, it would show the similar line until the last couple of months, which would show a complete drop, which tells you it's not a demand issue for the airline industry. It has everything to do with commodities like jet fuel and, of course, the labor shortage as well.
And there's a talk of energy commodities with Kriti Gupta, and that's the way we talk about commodities in the business media world. Oil, gold, oil, silver, more gold talk, oil. There's a whole other world out there. And Simon Casey is legit expertise in this. Bloomberg News managing editor in truly encyclopedic on the soft commodities like corn to the moon and the rest of it. Simon Casey, thank you so much for joining this morning. Let's talk about the immediate, which is a lot of snow across America, and that's the winter wheat that makes the Durham pasta for John Farrow. I mean, is winter wheat really threatened? Is our pasta crop threatened?
I mean, it depends what you mean by threatened. The conditions are certainly worsening, and the data that we had out yesterday from the USDA showed that the good to excellent condition across the crop has gone down something like covering like 30% or so of the entire crop in North America. So it's not good. I mean, it's not. There still will be a crop. It's not as good as it could be and would perhaps ordinarily be. And this comes on top of everything else, as you know, Tom. We've been talking about this for weeks now. The war, the impact on supplies coming out of the Black Sea, and then the fertilizer inflation shock, which is rippling around the world, and will have ramifications beyond this year. And it might even if the war does end at some point within the near future, this whole sort of confluence of events is going to continue to reverberate beyond
Simon, you raise a really good point. The cost of fertilizer has gone up tremendously. How much has wheat simply included that in the equation in the United States, and how much is it considered the increased demand globally, especially as wheat from Ukraine and Russia doesn't make it onto the market?
I mean, it's certainly factored into the price because the increase in fertilizer prices right now, we are seeing farmers around the world change their planting decisions here in the U.S., but also in places like India, really everywhere. And it's difficult to kind of pull that apart from the immediate supply disruptions from the war. But it's definitely sort of fundamental to what we're seeing right now.
I got to say, I'm watching corn really carefully, Simon. It's climbing to the highest since 2012 in the United States. And I wonder whether the U.S. can continue to push ethanol at a time when corn prices are as high as they are. Can they push this as a supplement to some of the other oil and gas supplies as a way to stave off some of the increases on that spectrum of the commodity scale?
Well, ever since the renewable fuel standard came in during the last decade, this has been a big sort of debate going on in the background. Should we be using food as a fuel for cars? It's as you know, intensely political in the U.S. It's heavily supported. It's got a lot of support from the farm states, and for that reason, no president can really sort of afford to tinker with it too much. I mean, as you know, Biden came out in the last couple of weeks and sort of pledged to actually support sales of ethanol with the higher version of the ethanol fuel that's out there in some fuel stations to extend the sales of that, the E15 blend. There's still speculation that ultimately he could do something a bit more drastic and sort of reverse course on the RFS ultimately. But oil prices right now, they've kind of tempered their gains. Gasoline prices not not quite as high as they were a few weeks ago. So, the way the political calculus is working right now, then maybe the Biden administration could keep it where it is. But if we see corn prices go beyond where they are now, I mean, right now we're at like a 13-year high. We're only about 40 cents a bushel off all-time highs. And you've got to think based on sort of global fundamentals, supply and demand fundamentals, and what we've seen in recent weeks. Corn could take out that record high. It could move higher. It could be $9 or even $10 a bushel, perhaps sometime this year. And maybe the political conversation shifts, and maybe the political conversation in this country and around the world is no longer so fixated on just on energy prices, but talks about food affordability and even global hunger.
Simon, tremendously important and deeply thoughtful stuff from you. Simon Casey, Bloomberg News Deputy Managing Director. And Thomas, a question you've asked. If inflation has peaked, okay, what's it coming back down to?
Yeah, well, I'm going to go to corn, which, it's not that big a deal, but you get substitution effects with soybeans as well, John. It's a lot more complex than just trotting out a price of a bushel of corn. I mean, there's a lot more going on here. We've got to study that in the coming weeks.
Coming up, Michael Bell at JP Morgan Asset Management on this equity market as we have a little bit of a lift on the S&P, up almost 0.1%. Heard on radio, seen on TV. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modelizaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We've seen a true regime shift, Tom, at all levels of the economy and the market.
Right now, we've got to deal with the disruptions in food markets, the rise in food prices.
You are seeing the consumer generally still plugging along, spending very strongly.
The Fed needs to readjust policy to the current circumstances.
A hard landing is inevitable. Whether it happens in 23 or 24, that depends on the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. A most momentous week. Tax day is so over. We look to May, and John, we do it within instabilities it witnessed by the speed of weakness. Weakness, I say, John, weakness in the Japanese yen.
Hey, Tom, it's over, but it still stings. For a lot of people, including me, it stings. It's going to be stinging a lot through this year with higher prices as well. And how people cut back on discretionary spending, I think, is going to be the focus for us all. And particularly with Netflix after the close as well. So on the earnings side, Tom, I'm looking to Netflix after the close later. Within foreign exchange, the macro story, I just think is fascinating. You've bring up the Japanese yen story. We've got this breakout in yields in America, Treasury yields higher. Breakout in Germany, bond yields higher. Japanese bond yields aren't doing anything, and so far the shock absorber in foreign exchange just seems to be the US dollar taking all the strength and the Japanese yen taking all the weakness.
And folding into that, maybe less so for service sector America, John, is the commodity boom that we're seeing, and it's truly a boom. Simon Casey is just lights out for Bloomberg, and that was a clinic on corn, the softs and all that away from oil. And you mentioned J.P. Morgan models out with some things happening, oil way over 150 a barrel.
Well, let's talk about the things that would need to happen. What they're modeling is the idea that the French get their way and you get a Russian oil ban, an oil embargo. How that gets phased in, though, I think is important. Is it an immediate cut-off or something that's phased in over time? Yeah. If it's an immediate cut-off, they think crude could go to 185. That's a big could, a good may happen. We don't know what's going to happen. We don't even know if the French will get their way. But certainly prices have gone up in a massive way. Out on Twitter just moments ago, here's a comment for you, Tom. Just filled up the car in Notting Hill. Now I have to go cap in hand to the IMF. Now, it's a joke, of course, but a lot of people feel that way over the last 6 months.
Lisa, Notting Hill, is that east of Fargo or west? I can't remember.
Really, you could ask me for
West London, Tom.
Yeah,
where,
exactly.
where
it's in London.
There are a lot of people in that particular
sorry, didn't know that.
part of London that can afford to fill up the tank.
But John makes a really good point, Tom, and I think that it really is salient for a moment when we're talking about the end of mask mandates in public transportation in a lot of places. The pandemic is over, and yet the rollover factors of inflation have not shifted, and people are changing their view on inflation. You're seeing that in bond markets, and you're seeing that in currency markets with the dollar ever stronger. And I do wonder, Tom, at what point people start talking about what happens if the inflation only gets down to 5% by the end of next year, let alone 2%, which is what the Fed is forecasting.
Well, Lisa, that goes to our conversation with Adam Posen in Washington and Olivier Blanchard the week before that. Maybe what we're talking about here is not getting back to 2% inflation, and there's a new level that says 1960s.
Well, and honestly, this to me stuck out. Wall Street Journal put out a report basically saying that the amount that the Fed would like to reduce inflation over the next 2 years has never been done before in the past 80 years without causing a hard landing.
I mean, John, the hard landing is the Bramo gloom. I get that.
Well,
John,
Dudley's in the club, isn't he?
Yeah, but can we stop and state that it's essentially a fully employed America?
In some measures, yes. Some people might push back. I know Danny Blanchard of Dartmouth would push back, but if you just look at the basic headline numbers, it looks like a very, very tight labour market. What you're picking up on, though, Tom, I think is really important. There is a difference between a mechanical peak in year-over-year inflation because the base effects start to kick in one way or the other.
Yeah.
There's a difference between that and the cumulative damage of persistently high inflation through the rest of this year, which is what most economists still forecast, Tom. So, yes, you can come down from 8, 7, 6, 5, But if we're looking at, say, 4 through next year as well,
or 3. Yeah,
we got a problem.
Even 3. What's Blanchflower know? He's stuck in a snowstorm up in Hanover this morning. John, Dow futures up 18.
Thank you for that, Tom. I believe they're up 16. On the S&P, we're up about 0.04% on the S&P 500.
Dow slam down.
I don't have the fast Bloomberg, John.
Every time you mention the Dow, I'm going to say that a currency pair is up or down instead of weaker or stronger.
That's good.
Okay? Euro dollar's
fair and
up
balanced.
0.1% to 1.094. The bond market, Tom's a story for me. I mean, we're at another 2 basis points on a 10-year to 287 and getting really, really close to a 3 handle on a 30-year yield at 297.
We will see. Michael Bell with us right now, global market strategist, EMA for JP Morgan Asset Management. Michael, I've got to go to the World Economic Outlook that we're going to get here in 1 hour, maybe an hour and a half. And a question that I've ignored, and I think in all the news about Europe and Ukraine as well. How is EM doing? Are we set up for a 1992 where EM gets a shock given what commodity prices are doing?
I mean, China is obviously the largest part of EM and is being weighed on by the lockdowns and COVID, which is just exacerbating the inflation problem in the developed market world because of the ongoing supply constraints there. In terms of some of the other emerging market economies, some of them obviously benefit from higher commodity prices through improved terms of trade. But I do fear that because those higher commodity prices are going to lead to more central bank tightening in the West, particularly from the Fed, that could create an environment that is difficult for some of those emerging market economies, particularly the ones which are highly reliant on foreign funding.
Michael, have we taken down earnings expectations enough sufficiently given what's taking place?
I don't think so, actually. I think that the risk is that earnings forecasts are still too high. I think, as you were saying earlier on, ultimately the question is going to be over the next 3-6 months, to what extent does consumption start to decelerate or at least grow at a less strong pace on the back of these higher energy prices? Now, it may be that actually in the US, consumption is able to hold up okay because people are still sat on pretty high savings from the pandemic. By our data, it suggests people are still sat on about double the savings they had pre-pandemic. Whereas in Europe and the UK, where we think savings are lower because you didn't get the stimulus checks, and also because they're paying much higher gas prices than in the US, I think the risk to consumption is higher.
Where does that leave the equity trade Europe versus US? I've just got a year-over-year breakdown, in fact, year-to-date breakdown of the Stock 600. Outperformance, basic resources, energy, up 23%, up 21% respectively year-to-date. The underperformance, as you might expect, the retail players down by 27%. I just wonder, Mike, how much work the market has already done to anticipate the story we're discussing and whether it's time to go the other way or not.
I think that if you look back to the low on European equities that we've seen this year, at that point, there was quite a high sort of recession probability already being priced in. But we've seen a bit of a rally since then. I mean, you look at the UK market, actually one of the better performing markets globally year to date. But of course, that's being helped by the fact that the big commodity producers, which make up a large part of the UK market, are doing pretty well. So I think you've got to look kind of beneath the hood of the market a little bit there. I do still think there's a bit of a risk that in the UK and Europe, markets are being a little bit complacent about the potential for a slowdown in consumption on the back of these higher energy prices. In the US, given that's less of a risk, I think the economic outlook is better in the US than it is in the UK and Europe. But as bond yields move higher, as we've seen, that can weigh on the tech stocks, which make up a larger part of the US market. So I think, if forced to pick at the moment, I would probably be looking at US value stocks, which are less exposed to that higher rate environment in a negative sense, and also less exposed to the growth shock from higher energy prices.
Given the lack of resilience that you point out relative to the U.S. in the European region, do you think that people are overestimating how much the ECB can raise rates?
I think they probably are, yes. I think that certainly in the UK, it seems to me that the pricing on rate rises is pretty aggressive given the likely slowdown in growth that we're going to see. I think that the likelihood is that over the next 6 months or so, and certainly as we head into next winter where these higher gas bills are really going to start to bite, that it becomes clear that actually both the BOE and the ECB are not going to be able to hike by as much as it's priced at the moment.
Mike Bell of JP Morgan Asset Management. Mike, thank you. As always, looking ahead to the BOE May 5th. So the Federal Reserve May 4th and May 5th, the Bank of England, Lisa, meeting as well.
Yeah, hiking into weakness seems to be a theme. At the same time, I do wonder whether they'll be able to back away given the optics of what people are facing in terms of the bills that they're paying. I mean, it was not an accident that the people who are cutting back on their streaming services were in the UK and that they were cutting back at a record pace. I mean, it's just been incredible how much the prices have risen of oil and gas.
Can we revisit the equity question? The market is meant to be a discounting mechanism. It's meant to price in a lot of this ahead of time. Mike Bow suggesting that perhaps we haven't done that sufficiently, Lisa, but we've had some massive moves from the likes of Netflix already, down 44% year to date.
Yeah, honestly, this to me was the most interesting thing that he said, that if we haven't priced it in, what's it going to take and how much more do we have to go? And we were talking earlier about the idea, Steve Chivarone was talking about big tech possibly needing another leg lower above 10% because of just simply the valuation story, if not the slowdown story. So then how do you trickle this out? But what will it take? I mean, we've all been talking about this. There have been outflows from equities. I mean, what will it take to actually tip the needle into even more bearish territory?
Spent a lot of time talking about the index, Tom. Beneath the index, on the S&P 500, the energy names are up by more than 40% year to date. If you look at the home builders year to date, we're down by 32 percentage points.
Yeah, there's some
a monster move already.
Yeah, there's been some sectors that, well, the equity market is getting out front, trying to guesstimate what the news will be, and certainly we've seen that with his home sectors. What I would suggest, John, is where is growth in 3 years or 5 years if you have any sense of optimism that some of these challenges will be resolved? That's not in the zeitgeist right now.
Tom Keene, Lisa Bramett and Jonathan Ferro, your equity market shaping up as follows. This Tuesday morning, good morning to you. We kick higher just a little bit, up a little bit more than 1/10% on the S&P, up 1/4% on the NASDAQ 100. Yields up by 3 basis points, 288.38 on a 10-year. This is Bloomberg.
Keeping up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine says Russia has launched a full-scale offensive to take control of the Donbass area in the eastern part of the country. Russia has made the capture of the Donbass its main goal in the war now that it failed to seize the Ukrainian capital, Kyiv. The attacks are taking place along a front of more than 300 miles. St. Louis Fed President James Bullard says the central bank shouldn't rule out rate increases of 75 basis points to fight inflation. In a presentation to the Council on Foreign Relations, Bullard said the Fed needs to move quickly to raise rates to around 3.5% this year. He also said that the talk of a U.S. recession is premature. Most major U.S. airlines are no longer requiring travelers or employees to wear masks on domestic and some international flights. That came just hours after a federal judge overturned a mandate for passengers to cover their faces. The airline industry had lobbied the Biden administration to ease the rule. Meanwhile, Uber is dropping its own mask mandate here in the U.S. Halliburton has written off all its Ukrainian assets 7 weeks into the Russian invasion. The company took a pre-tax charge of $22 million. Halliburton was the first major oilfield services contractor to announce plans to halt work in Russia. The Russian energy industry is heavily dependent on foreign expertise and equipment. And a new study finds that whilst bosses are anxious to get their staff back into the office, the rules don't always apply to them. 35% of non-executive employees are in the office 5 days a week, but only 19% of executives can say the same. That's according to a survey by Future Forum, a research consortium backed by messaging channel Slack. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Season is here.
A moment of multiple crises.
Bloomberg is fastest with the numbers and analysis.
You do have some good news and bad news.
It's a good time to own volatility.
Bloomberg, the fastest numbers and analysis you trust.
I think the most important thing for the United States right now is to remain united with our NATO allies, to continue to put pressure on the sanctions and try to squeeze them and enforce them, and to provide the weapons that are absolutely essential if the Ukrainians are going to continue their brave fight against the Russians.
That was Leon Panetta there, the chairman of the Panetta Institute for Public Policy from New York City this morning. Good morning. Futures advance in the equity market on the S&P and on the Nasdaq too. Up 0.2% on the Nasdaq 100, on the S&P 500, up around about 0.1%. Yields are higher by 3 basis points to 288 on a US 10-year. A little bit later this morning, 12 minutes away actually, we'll catch up with Mike McKee, Tom. We'll get some housing data.
Yeah.
Building permits, housing starts from Mike McKee for the US in about 10 minutes time.
They may not show, John, the 5% mortgage rate, but you wonder when that clicks in. And maybe not this report, maybe the next report, but there we are with a new high mortgage rate.
The struggle, Tom, 5%. It's going to hurt a lot of people.
Yeah, and it's tangible now, certainly the talk within New York City as well. This is a joy, because if you grow up in the plains of Kansas and you go east over to Washington to the Foreign Service of this nation and truly serve for decades, that describes a former ambassador to India, Robert Blackwell, who joins us now, Kissinger Fellow, the Council on Foreign Relations, and of course his public service to President Bush Sr., among other worthies. Ambassador, thank you so much for joining today. You, alive at this moment, are the definitive voice on the hope we had of mutual and balanced force reductions in Europe. You were there not in the 70s, but in the 80s, you were there, the Warsaw Pact and the Allies trying to figure out how to calm Europe down. That world has been turned upside down. Tell me how the Allies do a mutual and balanced force increase in Europe against Mr. Putin.
Well, first of all, the most important change, and it's a stunning change, and few forecast it, has been this very robust European reaction to the bloody invasion of Ukraine by the Russians, led, of course, by Putin. It wasn't anticipated because Americans for decades, and Secretary Panetta did his part in this, has urged Europe to increase their defense spending without very much success. But it is European publics horrified by the brutality of the Russian armed forces in Ukraine that are driving this, and there will be two consequences. A lot more money spent in Europe, led by the Germans, which are doubling their defense budget on defense.
Right.
And second, a forward deployment much closer to Russia by NATO forces.
Right. What's interesting here with all the different interviews we've done, Ambassador, I think of General Kimmett as one of the voices of really house-to-house and building-to-building combat, all the way out to others worried about World War III. When you hear people in America with not a reticence, but just a worry about a larger war, how do you respond to that?
I think there's reason to worry, for sure. And we see perhaps the beginning of an evolution of events that will accelerate that worry. That is to say, the offensive, which apparently began overnight in the Donbass by large Russian forces. It depends very much on how that fighting goes. If it turns out to be pretty much a stalemate, we need worry about escalation. But if, against most anticipations, if the Russians are routed, Putin will not accept a defeat in Ukraine. And what would his options then become? And it is not likely that he would use a nuclear device, a low-yield nuclear device, but it isn't any longer impossible. And so Americans and world citizens are right to worry about how Ukraine could escalate.
How does China play into this? Is it something that we should be talking about more or less?
China, of course, has Russia as its only strategic ally. The United States has about 35 of them through treaty commitments and arrangements. So they're going to stick by Russia. But they're essentially a bystander on this. According to the administration, China, at least so far, is not providing any weapons to Russia. And it'll do what it can within the sanctions regime. But it's a bystander and of course hopes that Russia is not humiliated.
Ambassador, just to pull this all together, are you saying that if Russia does not succeed in its offensive against Donbass, that potentially Vladimir Putin will start to be a little bit more rogue and expand the fight to NATO countries?
Not to NATO countries, I think. That would be an enormous step, because that would trigger Article 5 of the North Atlantic Treaty and trigger a war between NATO countries and Russia. And let me make clear again, what I'm speaking of with respect to escalation is if Russia is defeated in the Donbass and the Ukrainians are on their way to driving Russia out of Ukraine, in that instance, one would have to worry about Putin's belief that he now faced an existential threat, not just to Russia, but more important to himself. And I wouldn't rule out in that case extreme measures on his part.
Robert Blackwell, awesome to catch up with you, sir, as always. Robert Blackwell there of CFR. For a lot of people in this market, they've simply moved on from this story, at least as far as the market is concerned. The human tragedy is something we're all following still and hoping that the West can do some more to help. Bruno Le Maire, the French finance minister, earlier on this morning is making a renewed push on an oil ban. And you wonder, Tom, if that would bring this situation back onto the market's radar, because it's fallen off here in quite a material way in the last few weeks.
Well, oil sliding up 110 on Brent crude. It was up at 112, I believe, earlier. And John, the wraparound with Le Maire is, of course, the bitterness of this French election, which just in the last number of days has really almost hour by hour of campaigning gone topsy-turvy. You've got to fold that domestic story into the French foreign story as well.
Round two this Sunday, isn't it, Tom? What are you looking for?
I'm looking that we get in about 12 noon and, you know, have the results about 4 p.m.
I'm looking forward to your recreation of that Macron photo, Tom, with the buttons undone.
Yeah, the heavage.
Does that work? Does that work with the electorate in France?
I try it. I saw the same thing. I wasn't going to bring it up, John, but
well,
I'm glad you did.
Do you want to go there?
No, I don't. I don't.
No, I'm not suggesting you go there now.
Oh,
no,
okay.
I wasn't suggesting whether you wanted to talk about it, Tom. Let's not. 5 minutes away from housing data in America. Housing starts and building permits just around the corner, with mortgage rates in America getting back to 5%.
Rents are doing.
And to your point, Tom, maybe that's not the story for March, but perhaps for April, more so in May, June, July, etc.
Biggest mystery in America. No question about that.
The data coming up shortly. Mike McKee's going to break that down for you with Tom Keene, Lisa Bramett and Jonathan Ferro. Futures up by 0.05% on the S&P 500. Heard on radio, seen on TV. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Live from New York City on TV and radio, waiting for some economic data in America going into it. Futures just about positive on the S&P, up by 0.07%. Call it 0.06 on the S&P. On the Nasdaq 100, up about 0.1%. With your economic data on the housing market in America, here's Mike McKee.
Good morning, John. We are getting some numbers on housing starts and building permits, and they do seem to have gone up. Building permits up by, well, building permits, give me just a second to drag that one out, because housing starts are up by 0.3. Now, that's a significant decline from the 6.8% that we saw the month prior in March, and the total number has been revised in March to 1,865,000 on an annual rate. That's higher than the 1,859,000 initially reported. So we saw a stronger March than we had seen before, and that makes the percentage change for stronger February than we saw before. It makes percentage change for March a little bit less. Now, the important thing here in terms of building permits are up by about 0.4, is the shortfall in housing in the United States and whether or not the Fed is going to be cooling that market. And we have seen evidence that mortgage applications have fallen as interest rates have gone up. You mentioned the mortgage rate, John, earlier. It's now over 5% by most measures. What's interesting is housing completions are 4.5% below the February estimate, and that's going to keep the builders going. You take a look at what's been happening in the housing completions market, and we've been negative since the pandemic in terms of demand versus the actual housing. So there's still a reason to keep building even if rates are going up.
Michael, I'm going to squeeze in two quick questions here. The first is 5% mortgages affected in these numbers, or do they wait for next month?
Oh, it's not going to affect the Fed, and they're going to continue watching. I mean, this is what they want to see, is rates going up, and the markets have been going up. Market rates have been going up even without the Fed doing more than 125 basis point cut, or raise, rather.
Right, and the other thing, Michael, is Steve Dixon's out with a great story on, once again, Blackstone buying into the private real estate market, this time in student housing. What is your research on private equity's effect on the American housing market?
It's apparently been quite drastic. There's a shortage of supplies for homes, not just new homes that are being built in the data today, but existing family homes, and especially the starter homes have been snapped up by a lot of private equity, which makes it harder for people to get into the housing market. There are fewer houses available, so prices go up and affordability goes down.
Mike McKee, awesome, as always, buddy. Looking at this data, laser focused on it, Tom, in the months to come. To your point, that rate hasn't kicked in yet in a big way. The housing stocks have already started to anticipate this year to date, and as we've talked about them repeatedly, they are down in an ugly way year to date.
John, I'm bringing up the 2-year yield. I mean, we're at a 250, right? We just popped up to a new high on the 2-year yield.
Yeah, yields are higher across the board. The 10-year up 3 basis points. You wonder, Tom, whether this situation starts to kick in, and I think Lisa's spoken to this a few times already.
She has.
That the Fed's path is not sufficient for what they need to do, and they have to rethink it. And this goes back to the 75 basis point thing from Jim Bullard. That, for me, is a distraction.
Yeah.
The issue really is that he wants 3.5% by year end. The rest of the committee, and we're getting conflicting signals about this. 50, they're on board, ready to go, May 4th. The rest of the committee is talking about neutral with a low 2 handle on a Fed funds rate, and maybe going a little bit above that and stopping.
Right.
Jim Bullard thinks you need to go much higher than that. And I think Bill Dudley, the former New York Fed president, is making the same argument. And if that data in that particular part of this economy doesn't respond in the way that some people anticipate, maybe that's the story still to come, perhaps.
Let's get an adjustment on that with somebody who's won a number of trophies here for trying to get the economic guesstimate game correct. Gregory Dacko joins us now, chief economist, Ernst & Young Parthenon. EY Parthenon, we're thrilled he could join us today. You are really good at taking Atlanta GDP now and trying to sort it out to a guesstimate. You're with a consultancy, you're in a meeting with a client of Ernst & Young, and they go, where are we in a year? Where are we in a year?
Well, I think in a year we're going to be at a lower point in terms of economic activity. I think it's undoubted that we are seeing a slowdown in economic activity, and the Fed pressing hard on the brakes and wanting to press even harder on the policy brakes is going to accenentati that slowdown.
How do you respond to recession gloom and to the new game of trying to go out 12 months, 24 months? How do you, I mean, you're an award winner at this. How do you guesstimate out 18 months with this crazy economy we're in?
Well, I think first you have to understand where we are and where we are in the business cycle. We're in an economy that is still quite robust, but we are in a very unusual environment from a policy perspective. We have a number of central banks, not just the Fed, many central banks around the world are wanting to tighten. And that is a very unusual cycle when it comes to synchronized global tightening of monetary policy. That will weigh on economic activity in the US and around the world. And we have a number of geopolitical developments, the war in Ukraine, the lockdowns in China. Those are all going to impact economic activity going forward. So it's not a question of whether we are in a recession or will be in a recession in a month's time. It's a question of how rapidly the economy slows and how strongly the Fed presses on the policy brake over the coming months. I think 2023 is really going to be a key year in terms of economic activity.
Well, how does the Fed even begin to gauge this at a time when they haven't even started to unwind their balance sheet? They haven't made massive moves on their rate hikes. We're not looking at a Fed that's gotten aggressive. They're just talking with some aggression, perhaps. I mean, how much further do they have to go than the market is expecting in your view?
Well, I think the Fed has to continue pressing on the policy brake. We've seen the effect of forward guidance filter through to longer-term rates, as we were discussing earlier. We saw mortgage rates, and we're seeing mortgage rates up nearly 200 basis points over the past 3 months. That will weigh on interest rate-sensitive sectors. Real estate activity will cool, and we're going to see it not initially in the starts data, but actually in the sales data, and that will weigh on starts data later on. Construction activity, we know, has been lagging on the real estate front. That will still continue to hold up over the coming months because there's a shortfall in terms of available supply. But overall, this Fed tightening of monetary policy will weigh on the economy via the credit channel, but also, and perhaps more importantly, via the financial conditions channel. And we haven't seen the full extent of that, I think.
Greg, if the Fed goes through with what's expected of them, where do you think the inflation rate will end next year, CPI?
I think inflation will take some time to come back down. Even if the Fed is much more deliberate in terms of raising interest rates, probably 50 basis points at the next 2 meetings and a rate hike at all the other meetings through the end of the year, even with that tightening, inflation will take some time to come back down.
Let's go to your wheelhouse then on that. If we get 50-50, whatever the parlor game is, in the old days, we used to go, what's it mean for business? What's it mean for corporate America? Does that question matter anymore?
I think it does, because it affects both consumer spending and business investment.
What is business investment going to do given this original leaps? Forget about 75 beeps, but these leaps up.
That's the key uncertainty that we're facing right now, because businesses are uncertain about the outlook. We were in an environment where demand was quite robust and where tightening of interest rates would affect the cost of credit. But as we look into 2023, there's a question about pricing power. And in an environment where you're more constrained in terms of pricing power, how do you pass on the higher input cost, the higher wage cost in an environment where interest rates are higher?
So are you agreeing with Bill Dudley, Dr. Dudley, that we're back to the 60s? Everybody's focused on dismal 70s, and he's saying, forget about that. It's Walter Heller in the 1960s.
I think we're in 2022. I don't think it's good to compare to any historical precedent. There are similarities across time.
Makes for good theater, you got to admit.
But this is a very unusual business cycle, much faster than anything we've seen. And I think there are 2 important themes to remember. When you're rebalancing, you rarely come out where you wanted to come out, and the initial, the end point is very different from the starting point. So we have to be cognizant of the fact that this rebalancing will be unique in its own, and it will lead to a very different economic cycle this time around than anything we've seen in the past.
Greg, do you agree with Bill Dudley that if the Fed does not somehow spur or at least allow some sort of downturn in the next 2 years, that the end terminal Fed funds rate is going to be a lot higher and the pain a lot greater in the long run?
Well, I think it's clear that the Fed wants to get control over inflation. It wants to regain control over the inflation narrative. It will tighten monetary policy, use its full arsenal to do so. The key question is how high it needs to go to do so. I think we have to remember that the Fed is in this very unusual position of having to tighten very late in the game in terms of monetary policy. The tightening cycle this time around will probably be the fastest since 1994. It wants to get back to neutral as quickly as possible to avoid having inflation move further up. But we have to consider the fact that there may be some recalibration even in 2023 of monetary policy, because as I said, they're going to be tightening in an economy that is slowing, not accelerating, and that will make a soft landing a very difficult task.
Greg Dacre of EY Parthenon. Will Dudley agrees with this. Great to catch up, as always. TK, you picked up on a move at the front end, up by almost 7 basis points now on a 2-year to 251. We're very close to 3% on a 30-year, up 4 or 5 basis points. I think we can round that up, Tom. 299 on a 30-year.
And with a leg up, and there's a thrust here is the way I would put it. Colby Smith and the FT used the word surge here. Maybe that captures it, John, but, you know, housing comes out, McKee reports on it, and with all the distractions that we've got, I think we're forgetting about looking actually at the market data, and you just see it with a surge is the only word for it, and the 2-year yield almost up to 252.
That's the US, a move in Germany too, Lisa. It's global,
9,
global ex-Japan. Let's put it that way. Up 10 basis points in a bond market on a German 10-year to 94 basis points.
I just wonder, do we get to the point where economic data suggests that the Fed is not working to curtail inflation? And how much does that become a liability for markets? I mean, honestly, the idea that we got better than expected starts data, that we saw the fastest pace of housing starts going back to 2006, seems to be jarring to a market looking at 5% mortgage rates.
Bramo, before I run, someone messaged me and asked whether you're holding that mask burning party later on this afternoon or into the weekend.
Details TBD.
You haven't decided?
Yeah,
okay.
But they can bring a kegger.
They can bring a what?
You don't even know what that is? Come on, what happened?
A kegger?
Well, that's like a term.
Oh, I didn't know. It's an education bit on this program.
It's amazing.
I know, the things you learn, Tom.
Discussion.
Really important stuff.
It is.
Troy Gayeski of FS Investments is going to be joining us on the show.
What
in
show?
20 minutes.
What show?
The show.
Oh, boy.
Show.
The show.
The show. The show.
This
He'll
is
probably
Bloomberg.
quote the Dow.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. In Ukraine, President Volodymyr Zelensky says a long-anticipated Russian offensive has begun. Russian forces are said to be targeting the Donbass region in the eastern part of the country. The assault is taking place along a front of more than 300 miles. And it is a fresh blow to Russia's billionaires. President Vladimir Putin has dropped the curtain on the era of foreign stock listings. Putin has signed off on legal amendments that require Russian companies to delist their overseas shares. That could force tycoons such as Vladimir Putin to reconfigure the structure of businesses they hold via overseas shares, paying foreign currency dividends. And Blackstone is increasing its bet on student housing. It's agreed to buy college housing owner American Campus Communities in a cash transaction valued at about $12.8 billion. Rents for student housing stayed high during the pandemic, and there's relatively little new construction going on. Last year, Blackstone formed a $784 million joint venture with Landmark Properties for college housing. And Johnson & Johnson has cut its profit forecast for the full year. The guidance missed the average analyst estimate. Meanwhile, J&J is suspending its guidance for COVID vaccine sales because of unclear demand and a global supply surplus. And Bloomberg's learned that Nomura lost about $13 million on transactions linked to inflation in the UK. The Japanese lender tried to expand its sterling-based inflation trading business early last year, but traders were stung by sharp moves in British consumer prices. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Increasingly, we are moving our securitizations onto blockchain. We're taking stakes and backing challengers to the financial system. Fintech is here to stay. Blockchain is here to stay. Crypto, I think jury out.
Mark Rowan, Apollo Global Management CEO, after, I'm going to say, 24 months of uproar, in conversation with David Rubenstein. The full interview tonight, Bloomberg Wealth with David Rubenstein at 9 p.m. And for Global Wall Street and New York Wall Street, an important conversation. David Rubenstein here right now. Tell us why this is important. Is the company stabilized after the uproar of the last few years?
I think Apollo's in really good shape because Apollo has the core business that it's historically had, private equity, private credit, but they have Athene, which is roughly the same size as their other part of Apollo. And Athene is a cash cow. It's a retirement services business. Mark Rowan really bought it, he built it, and now he's in a very secure position.
This is a guy who's done it right. He's superior academics at Pennsylvania. In he goes, Drexel Burnham Lambert, I think at the back end of it. And then he's built out the career. What is distinctive about him among the private equity people you deal with every day?
Of the people who are the so-called second generation running these large private equity firms, he is one of the few people who actually was a founder, and he's also extremely wealthy, and he's already made his mark. By buying Athene for Apollo, he's made Apollo extremely successful. So he has the luxury of being secure. He's already extremely wealthy. He's well respected and well liked, and I think he's enjoying the job because before he was not as visible as others, and he was in some ways he had a semi-sabbatical. He wasn't there as much as others. Now he's there full time. He loves the job. I've never seen him as happy.
How much does he embrace, David, this idea that the shadow banking system, private equity firms, private investors are really taking over a lot of the banking functions of the traditional finance companies, which Jamie Dimon of JP Morgan last week was complaining about?
Well, J.P. Morgan's in pretty good shape. I don't think they have to worry about the private equity firms. But the private equity firms have moved into areas like private credit, and private credit has become a gigantic business for all the large private equity firms. But they are not anywhere near the point where they're threatening J.P. Morgan's core business. It's just a different niche that the private equity firms have moved into.
Yeah, but how much, David, are we talking about blockchain and some of these other types of non-traditional finance, of codified financial tools that will become the next frontier that perhaps traditional finance moves too slowly in, and some of these other firms can be faster?
That's the bigger threat for the large commercial banks, whether somebody comes along with a new technology, a blockchain, or some other kind of fintech revolution that basically changes dramatically the core business of banks. That's what they should worry more about than whether private equity people are getting a little bit into their businesses.
Are guys like you taking over real estate in America, over cocktails on a weekend? You must be asked this 6 times a weekend. Is private equity, with their suppleness, with their privacy, are they taking over forms of citizen real estate in America?
I don't really think so. I think private equity is still a small business compared to other large commercial banks and so forth. They're growing a great deal, but private equity is not threatening anybody.
That capital input doesn't change. I'm talking Chicago here. That capital input doesn't change the price theory of an individual home.
I don't think it does in any material way. And to be honest, private equity is not as controversial, I think, than it was 10 years ago. 10 years ago, people were upset about private equity buying companies. Now people recognize that private equity people care about ESG. Private equity people are doing the things that all big companies should do. So I don't think it's seen as a big threat. In Washington, D.C. today, private equity is not even the top 100 things that people are worried about on Capitol Hill.
Do you think it's still an opportunity, though, the housing market, in particular buying to rent, that it was, say, 3 years ago?
Well, yes, I think private equity has some challenges for sure, and I think the debt markets are challenging for private equity because as interest rates go up, it's going to be more challenging to finance some of these transactions, but there's plenty of liquidity. I think the biggest problems that private equity people are worried about today is the economy, generally, the overall economy.
David, I don't want to, start any rumors here, right? I mean, I don't want to, folks, but I saw you tweeting before we went to air here. Do you have any comment? I mean, you were tweeting as we went to air. Do you have any comment here on the transaction known as Twitter?
Actually, that transaction, a lot of people will look at it.
Let me get my phone out here so I can tweet the answer.
It's a complicated, very large transaction. It'll be a very large buyout. And if it gets done by any private equity firm, there will be many private equity firms involved, not just on the equity, but also on the debt.
You have decades of experience as this. Is Mr. Musk treated differently by Mr. Gensler and the Securities Exchange Commission than other executives, the 6,000 executives you've had experience with?
I can't really say because I can't say exactly what's in his mind, but there's no doubt if you're the wealthiest person in the world, people look at you somewhat differently.
Lisa, I'm getting the I'm never coming back look.
Well, it's a delicate thing.
I'm always coming back.
Apollo Global was actually named as somebody who might be interested in this transaction, so I'm sure it's deeply relevant. But there is this question about what the new frontier is for social media and whether there might be more regulatory involvement. David, I do wonder going forward, what is your strongest conviction as you look out among myriad threats in a world that seems highly uncertain?
Well, the strongest conviction I have now about where the world is going is that we're likely to see an economic slowdown at some point. I don't think it's a recession, but obviously higher interest rates are coming. We're likely to have a 50 basis point increase the next time the FOMC meets. Until the Russia-Ukraine war is resolved, I think the markets are going to be really jittery. And it looks as if that war is going to go on for another month or two at least. So I think the markets are still a little bit nervous about where things are going.
We appreciate your weekly attendance here. David Rubenstein, of course, always and forever with Carlisle, and of course, his conversation with Mark Rowan, the Apollo Global Management CEO. Look for that on Bloomberg Wealth this evening. Lisa, there's so much to talk about here. I guess we've got to go to the 2-year yield while Mr. Rubenstein was speaking at 251 out to 253.
This, to me, is the biggest story of the moment, the idea that we are looking at housing starts that came in at the fastest pace, unexpectedly, since 2006. Is the Fed working?
Well,
is the Fed being effective at talking down inflation? If you have inflation expectations on the longer end that actually are rising, and you don't seem to see any material slowdown in some of these dynamic aspects of the market, including house building.
And this goes to the force of Jan Hatzius the other day, talking about a fully employed America just pushing against all the gloom. If people have jobs, is anybody talking, Lisa, about reduced labor?
No, no one's talking about that. People are wondering how much we are going to get an overheated kind of feel to it, but we are looking at a participation rate that still is pretty low, but those people aren't coming back in. We had expected that to be already the case, given the fact that we've already seemed to be shifting toward an endemic phase.
We've got lots to talk about here. I want to drive to this afternoon in the close where we'll have Netflix earning. This is a really important theme as we begin the post-bank earnings season here. The haves and have-nots of revenue growth. We saw that with J&J today, use of cash with a dividend increase, but J&J with some challenging forward view, and you really wonder if that will be a trend in the equity markets. The equity market is all over the place. I don't know really what to say. Green, now all red, slightly and fractionally on the screen as well. And of course, the number one thing that all of us are looking at today is weakness in the Japanese yen. Is it possible we will see 130 yen? A timely conversation, balance of power at noon today. Jacob Lew, the former U.S. Treasury Secretary. Please stay with us. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder,
isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Live from New York City this morning. Good morning, good morning. Big tech coming after the close, going into the open. Futures just a little bit negative. The countdown to that open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, struggling for a clearer outlook.
There's a lot of uncertainty.
Tons of uncertainty.
The economic outlook.
Slowdown in global economic growth.
Growth, I think, is still in a very difficult place.
Some demand destruction. And tightening global liquidity.
Earnings season.
The question is, will they be able to maintain their margins?
We have to watch those costs.
A lot of these cost increases.
What's being said about current conditions.
The market, rather than focusing on the hard numbers going forward, is probably going to be more focused on the guidance.
Markets operate on narratives more so than numerology.
This is a time for a defensive play.
The worry, of course, is what is the outlook for the next quarter or for the rest of this year?
I don't think, frankly, any of us know.
And clearly the IMF does not know either. They've had to cut their outlook as well this morning, cut their outlook for growth and raise their outlook for inflation. Joining us now is G Squared's Victoria Green, Troy Gayeski of FS Investment Solutions. Victoria, the IMF goes to 3.6% from 4.4% for their global growth outlook. They're usually the last to know. Forgive the snark, but I'm just trying to work out whether the equity markets already got ahead of most of this.
Yeah, look, equity markets are pricing in a lot of uncertainty. You know, the buzzword for Q1 is uncertainty and price pressures and margins. But look, it's not a great outlook. We're stuck in a quagmire in Ukraine. We see a rising sanctions and anger against Russia. The world is getting smaller. We're really not certain where China is going to come in on all this and how regulation and how they're going to respond to Russia and how we respond to their response to Russia. So, yeah, I think right now it is time to play defense. Things are going to slow down. The question I have right now, I kind of consider it the 3 Ps. Is this peak? Is this plateau? Or is this going to be persistent and higher on inflation? And so I think that is one of the biggest questions right now. Which one of those 3 Ps is going to happen?
Victoria, what's more important to you? Because you could get both. You could have a mechanical peak in CPI this year. That could have taken place last month. You could also get more persistent above target inflation into next year. It just might have a 4 handle, a 5, maybe even a 6. What's the more important factor for you in your outlook?
Yeah, I think it's going to be plateau. I don't think peak is happening. Peak, I consider up the mountain, down the mountain. We've certainly come up the mountain very quickly on how fast inflation has been rising. I see it persistent, absolutely. And while we may come off peak numbers and peak growth, some of that core PCE, you know, I know we all kind of breathe a sigh of relief that, oh my God, used car prices came down for once. But I think there's going to be a lot more persistent, and I'm not sure that's going to be a trend that you see core PCE coming down. So I think it's persistent. I think you're going to see the 5-6 handle through year end, and I think that's going to pressure the consumer, absolutely.
Troy Gayeski, your thoughts?
Yeah, so look, I mean, this is a whole new backdrop for investors, right? We have persistent inflation, persistent nominal GDP growth outstripping real GDP, you know, certainly the potential for further multiple compression and also higher yields in fixed income. And so, you know, times like these, it's best to step back and focus on strategies that are actually benefiting from the Fed hiking. You know, our slogan is don't fight the Fed, high five the Fed. You know, go after senior secured commercial real estate debt that's floating rate and very economically resilient. If you have a tolerance for liquidity, you can invest in BDCs. FSK would be ours, that trades at a significant discount to NAV and is close to 11% dividend yield and is primarily invested in floating rate securities. And you're starting to see real opportunities in CLOs now, which are fully floating rate as well. So there are some interval fund structures out there that can participate in that. So given the persistence of inflation and the uncertainty, good lead into the segment, by the way, John, you know, that's where people should be focused. And you should stop trying to guess whether everything's priced in or not, because it would be very unusual if all the Fed tightening and all of this dramatic transition from a low nominal GDP environment, low inflation environment, to a much higher sustained inflationary environment is priced in today.
Troy, how am I meant to play the higher rate story in the equity market when utilities have been outperforming and banks have been underperforming?
Yeah, look, I think that's when you focus on one of the nicher areas of the markets, business development corporations, which are focused on primarily senior secured floating rate instruments, not exclusively. And there, the underlying assets, provided the debt service coverage ratios are still attractive, will benefit from Fed hikes. And in the case of some of them, if they trade at a significant discount to NAV, you can have that pull to NAV while you're collecting more income. So that's a nicher area. It's only about $125 billion marketplace. But if you look at the performance of FSK, for instance, year to date, it's vastly outstripping broader markets, both fixed income and equities, and doing it with a very high dividend yield. So that's one nichier area that you can play right now.
If you're just tuning in, the IMF coming out with their global growth outlook, that gets a cut. Their inflation forecast, that gets a lift. We've anticipated a lot of this in this equity market, the bond market as well, ahead of the Fed decision on May 4th. A 50 basis point move or a 75 basis point move. Take a listen to what Jim Bullard of the St. Louis Fed had to say.
I would point out that the 1994 cycle, where we raised the policy rate 300 basis points in a year, and in that cycle, there was a 75 basis point increase at one point. So I wouldn't rule it out, but it's not my base case here.
Mike McKee, he wouldn't rule it out, but it is not his base case going into May.
I think Jim's just trying to keep us interested here.
I think
Instead of just we're going to price 25 forever, he's going to keep us interested. He is the sort of leading hawk voice on the Open Market Committee. And some are asking whether or not he's leading the committee and leading the markets at the same time. You take a look at his speeches over the last couple of months. They are pretty much aligned with a significant rise in the two-year yield, which is everybody on Wall Street's proxy for where they think the economy is going. And there you see the Fed funds rate that people are talking about for 2023. And as Bullard talks more, it goes up. So let's see if he turns out to be right. Now, the other question is, do we have a recession because the Fed goes too far too fast? It's starting to get out there. Fannie Mae just out with a press release this morning saying they're calling for a recession in 2023. But the IMF numbers that we just got, not looking for that. They're looking for GDP to fall about half of where it was, down to 3.6%, but they're seeing positive inflation numbers, positive GDP numbers, with inflation going down. The real question is going to be what happens in Europe. They're looking at, for the IMF, 7.5% inflation in 2023. So maybe we need to ask what the ECB is doing. Meanwhile, this is what the market is doing. Jim Bullard is calling for 350 basis points by the end of the year, but the market, you can see what we've done there is added in each move. The market only gets to 2.4%. So there is a disconnect between Bullard and the market in terms of where we will be at the end of the year. We're going to have to wait and see how the Fed judges the progress of the economy as we go along. They're not making forecasts any different than the IMF at this point.
And Mike McKee, thank you, sir. Big move in this Treasury market this morning. Let's go through it together. Up 10 basis points on a 2-year to 255. On a 10-year, up 7 basis points to about 292. On a 30-year, just about short of that 3% line in the sand at 299, up 6 basis points there. But a breakout on a 2-year on the front end in the last hour or so. Troy, I want to come to you on that. When we talk about Jim Bullard and the St. Louis Fed, I know everyone wants to talk about 50 and 75. What's more interesting to me, and I think to others as well, is this idea that he wants to get Fed funds to a 3 handle, 3.5% by year end. I'm just wondering what you're looking for, what you're factoring in.
Yeah, so, I mean, the pace is important, as is the magnitude, right? But basically what's happened the last 2 weeks, as you know, is various Fed members, most notably Brainerd, have rolled out and have done their best to jawbone up the pace and magnitude of tightening. We think 3% makes a lot of sense, maybe 3.5%. You know, it did look like they're mainly going to focus on the bank channel, right? Raise the front end, disincentivize banks to lend to slow down inflation. You know, our biggest concern is whether they take it to 3 to 3.5 and are also significantly draining the balance sheet. You know, so far they haven't drained the balance sheet at all. They're so concerned with inflation. that they've actually increased the balance sheet over the past several weeks. So, you got to kind of shake your head there. But certainly the more hawkish members are trying to talk markets into tightening financial conditions ahead of them doing anything. But it is entirely possible to see a 3 to 3.5% above neutral rate if they choose to go more aggressively. That's just not our base case right now.
Well, we had the 30-year there very, very briefly at just north of 3%, back to about 2.99 now. Victoria, your words, quote, "The only way to stop inflation is recession." Do you believe that's what's going to happen here?
Yes, historically, the Fed has not performed well in these situations. I know Bullard wants to get to 3.5. I think they're trying the hardest they can and as fast as they can to put as much room between them and zero as possible so that they can come back down to earth when market conditions start to flip over. Look, nothing has signaled absolute recession yet at all, but you're getting kind of these canaries in the coal mines. And when you look at how much tighter can the labor market really go, when are we going to see relief on inflation? What do we think about sentiment? What do we think about confidence? And even home builders, it was a bit of a surprise on the upside today, but with the mortgage rates at 5%, is that going to start to slow it down? So yes, I do think it's going to end up pulling us into a recession. Historically, this is not where the Fed has shined, coming out of a very difficult inflation era. And all we're hoping for is a soft landing. And I think that is a moonshot at this point, just because this isn't something they shine at. They're always late or they move too aggressively. Honestly, I think Powell is also being the uber hawk right now to give them some wiggle room where they could potentially come in and expectations are set for a hawkish Fed, and he's putting out numbers. I don't even know if they get to 3.5. If you look at the dot plot, they never get to 3.5 on the average target before they have to roll over in 24, and I'm not really sure they're going to make it to 24 before they have to start easing again.
Victoria Green, Troy Gajewski, with a big call right at the end there that I'll return to in just a moment. The home builders as well. Victoria mentioned the home builders down by more than 30% year to date. It has been absolutely brutal for them. About 20 minutes away from the opening bell. Back with us, I'm pleased to say, with some movers. It's Taylor Riggs.
John, I have some good movers for you this morning. First, take a look at Halliburton. And I think we're actually in the middle of some call because also getting some big headlines as well, talking a lot about some of those Ukrainian and those Russian assets. The CEO saying that the supply chains in Russia at best strained, right? So that sort of paints that picture. Also coming out with a big write-down of all of those Ukrainian assets, if we want to talk about the balance sheet of that, taking, of course, a pre-tax charge of about $22 million, just a full write-down there. Overall, though, sort of matched on the top and the bottom lines, and you're getting some year-over-year increases, but again, really highlighting some of those supply chain issues, particularly within that oil space. Let's go to Johnson & Johnson. Overall, of course, the sales miss, but really all about that vaccine revenue, John. A miss there, and really it's all about that full-year guidance, cutting the full-year earnings per share outlook, and suspending that COVID vaccine guidance as well. Maybe perhaps they're on some forward weakness going forward. Plug Power is a good one, moving here to the upside by about 7%. Jumping here on a contract to supply hydrogen power to Walmart trucks, Walmart forklifts, some other equipment here to help Walmart pivot to more green energy. And finally, this is another deal there. That American campus, Blackstone buying that college, perhaps supplier here for about $12.8 billion of some of those apartments, private equity, deepening student housing exposure. John.
Hey, Taylor, thank you. Lucky to have Taylor Riggs with us this morning. She'll stay with us through the opening bell. Coming up, Russia's military launching a new assault against Ukraine.
We have continued to see the concentration of their airstrikes and artillery in the Donbass and in the south, particularly around and in Mariupol.
And the French government pushing for a ban on Russian crude. That conversation up next.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Season is coming.
The bar is pretty high.
We're going to see lower earnings growth.
The sentiment on financials has been pretty dour.
Bloomberg breaks the numbers first.
Tesla's gaining on record deliveries for the first quarter.
The industrial sector is getting hit pretty hard.
Every tick down is a big deal.
With exclusive expert analysis.
There are a couple of things that concern us.
We have to break out a different playbook.
There are opportunities out there.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We have seen the Russians continue to flow in. They're trying to set the conditions for more aggressive, more overt, and larger ground maneuvers in the Donbass.
President Biden speaking with Western allies, hosting a call within the next hour or so. France, meanwhile, pushing for sanctions on Russian crude following Putin's latest assault on the Donbass. The Finance Minister, Bruno Le Maire, saying the following: if we haven't got there today, it isn't because France doesn't want to. It's because certain European partners are still hesitating. Bloomberg's Will Kennedy joins us now from London for more. Well, I wanted to go straight to a quote from JP Morgan. They put out some research off the back of this push by the French, and they put out a number as well of 185 on crude. Here's the quote: the European Union is considering fully banning Russian crude, a measure that, if executed immediately, that part's key, would likely drive Brent crude oil prices to 185 a barrel, as more than 4 million barrels a day of Russian crude supplies would be displaced with neither room nor time to reroute them. Well, can we pick things up on the last line there? Just how much Russian crude has been displaced over the last couple of months?
Well, the IEA had estimated that in April it would be 3 million barrels a day. It looks like we're going to come in quite short of that, maybe at less than 1 million barrels a day so far. But I think the direction of travel is important here, John, that it's clear that production is starting to fall in Russia and will continue to fall as more people back away from buying Russian crude, and that deals and long-term contracts agreed before the invasion fall away. So it hasn't been as bad as people expect, but it is getting worse. It is having more of an impact, and clearly anything that the European Union do in the next round of sanctions has the ability to add to that markedly.
Well, when the French say other European partners, a lot of people believe they mean the Germans, so the Germans specifically. Will, for the people you speak to, are they anticipating this is something that actually will happen, or something that the Germans will ultimately prevent from happening?
I think there's a consensus that the EU needs to do more on energy. The Germans have a bigger problem with gas, so it may be that doing something on oil is a way of a bit of a quid pro quo, is that Germany avoids the very serious impact of big gas sanctions would have on their economy. Their industrial sector relies hugely on cheap imports of Russian natural gas. So I think something will happen on oil. The key things that we don't know, as you alluded to at the start, is when, how quickly, and how absolute it is. A ban is one thing, but we need to know how it would be phased in over a number of months, you know, maybe a ratchet down lower. And there's still some talk that rather than a ban, there would be a tariff on imports and trying to attack shipments into Europe that way. So it's unclear, but I think something on oil will happen.
Really important. Will Kennedy, thank you, sir, out of London. Just the language that JP Morgan are using here to get to that 185, if executed immediately, and of course, If it's executed immediately, does that mean we take all Russian crude off all at once and that ban is absolute, or is it something that's phased in with caps over time? And obviously, different scenarios have different implications for your price target, and JP Morgan throwing out a 185. If the whole thing is executed immediately and absolutely, remains to be seen whether we get that. Victoria Green and Troy Gayeski back with us. Victoria, you said earlier on, about 10 minutes ago, the only way to stop inflation is recession. You also said that we could see them easing again by, I think, 2024. With that all in mind, how much longer can energy keep outperforming, energy equities specifically?
Yeah, I think they're going to outperform throughout this entire crisis, honestly. This is a crisis kind of built on commodities, and if you look at what's happening with supply and demand and what Europe might do, I don't think they're going to act immediately. I think that's shooting their economy too hard in the foot. I think everybody's expecting a European recession, honestly, by the end of this year, just because of the impact of Ukraine and what they need to do and how ingrained their economies were. You know, globalization was great until you try to deglobalize. And so ripping the Band-Aid off may not be economically feasible for them. But look, you're taking this Russian crude off the market. Maybe India buys it, maybe Russia buys it, maybe they find some other people in that kind of sphere of influence they still have that'll buy it. But it's a massive amount of oil and gas you're taking off the market. Getting it there is not the easiest. You know, you have transport, shipping, and terminals that you have to deal with. But I do think crude is going to stay elevated. I think we're not going to release Russian sanctions. You know, even if we got a ceasefire tomorrow, which I doubt, I don't think anybody's going to want to play nice with Russia again. I think everybody got burned. I think Europe is saying, hey, we're going to hard pivot away from this. And I think everybody's reassessing who their allies are and if they want to be even doing business with the quasi-allies anymore because of the risk it puts their economy. So, yeah, I think oil, if you look at what the futures are pricing out, it stays elevated, maybe 90 plus. Hopefully we stay, you know, below 130. You know, some of these would be a supply shock. If it happened, you know, OPEC has shown no willingness whatsoever to step in. They're not even producing up to their limit, and the increases that they're announcing just because of some of the problems they're having in OPEC nations right now, you're not even seeing that supply come on the market. So it is going to stay elevated, unfortunately. You have seen some relief at the pump. We're down to $4.10 a gallon now, so we're off 22 cents from the highs, but it hasn't come off enough to really help people yet.
Troy Gayeski, energy equities are up 46% almost on the S&P 500. Do you agree they can continue to outperform?
Yeah, look, in our tactical asset allocation franchise and real asset fund, we maintain an overweight to basic materials broadly, including energy. And remember, it's unfortunate to profit from a tragedy like this. But that being said, one of the key parts of the thesis has been that we're in a complete capital constrained environment, right? After being profligate free cash flow destroyers, the energy industry's become very conservative with new investment. And so that's leading to significant profits, you know, at these oil levels, even at materially lower oil levels. And so, you know, one thing we've been highly convicted in is that there's a higher floor under the commodity complex, given the lack of investment across the board, including energy this time, not just copper and ags. And so that should lead to tremendous free cash flow production. And relative to other parts of the market, which you didn't bring up, but clearly oil at 185 does increase recession risk materially. You know, the majority of Western economies and corporate entities are punished by higher energy prices, where clearly, you know, energy companies benefit directly over the short, medium, and long term.
Troy Gayeski, alongside Victoria Green, to the both of you. Thank you. Fascinating morning, about 8 minutes away from the opening bell. Brent crude down about 2.9%, WTI down by a little more than 3. Big moves in this bond market. You've got yields higher in the Treasury market on a 10-year by about 5 basis points, 291. On 30s, through 3%, briefly, then back to about 299. A 2-year up 9 basis points to 254. In Germany, we're seeing a similar move, up by 10 basis points or so on a German 10-year to about 94 basis points. In Japan, you do not see the same thing at all. Month to date, the 10-year Treasury is up more than 50 basis points. The German 10-year up more than 40 basis points. The Japanese 10-year up 2 basis points month to date. Dollar yen on a 13th straight day of yen weakness against the US dollar. With all that in mind, the Fed's on the move. The ECB could join him later this year. The Bank of Japan has no interest in doing the same thing whatsoever. And for that reason, we've got dollar yen up to 128, 128.65. Up next, the morning calls, and later, gearing up for big tech earnings. Netflix on deck after the close.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
We are 5 minutes away from the opening bell in New York City this morning. Good morning to you. Equity futures unchanged on the S&P, slightly negative on the Nasdaq by 0.2%. That's the price action here in the morning calls. First up, Citi downgrading NXP Semiconductors to neutral, warning of limited upside amid peaking gross margins. That stock is down by 2.5%. Truist upgrading Lululemon to buy, expecting management to provide a new and robust long-term outlook at its analyst day tomorrow. And finally, Rosenblatt initiating coverage on Snap with a buy rating, highlighting the company's improving user growth trends. That stock is positive by 0.5%. Coming up, big tech earnings on deck. Netflix reporting after the closing bell, after collapsing more than 40% already this year. That's next. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
24 seconds away from the opening bell in New York City this morning. Good morning. The IMF finally catching up, dropping their outlook for growth, kicking higher their outlook for inflation. We've been talking about that all year. Equity futures on the S&P 500 essentially unchanged. On the Nasdaq, positive about 0.1%. On a Russell, we're negative on the Nasdaq 100 by 0.2%. As you open about, switch on the board and get to the bond market. What a move we've seen in treasuries, particularly the 30-year, very briefly through 3% for the first time since 2019. On a 10-year, above 290, 290.70, and up by more than 5 basis points today. It is not just the treasury market, it's Europe too, with German bund yields breaking out as well. Euro dollar positive 0.1% at 107.94. A bigger move in dollar yen we've discussed a little bit earlier this morning. And a move to the downside on crude. WTI down by 3.4% at 104.50. So in about 30 seconds into the open, we're down 0.5% on energy stocks this morning. That's where your underperformance is. The S&P more broadly is basically flat. Real estate outperforms up 0.5%. Industrials too up 0.4. Financials as well up by 0.4%. Breaking down some of the early movers. Back with us is Taylor.
And John, let's start with some of those energy movers, right? I mentioned Halliburton, of course, at the top of the hour. Quickly, just want to revisit, of course, as we get further comments, not only about the write-down of the assets over there in Ukraine, but talking a lot about the supply chain issues pretty much across the board, and of course, in Russia. So you're really seeing those shares off just about 1.5% or so. Travelers, look, there's a first quarter that missed analyst expectations. And analysts over at Piper Sandler said that the underlying margins were worse than expected. You take a look at Lockheed Martin as well, sales falling 8% year over year and falling in 3 of the 4 categories. The one category that did see a year over year increase was basically Unge. So that sort of explains that picture. Finally, Alibaba here. You know, John, this has sort of been a bellwether perhaps for some of the Chinese stocks. The latest news, of course, just further crackdowns, in particular in the live streaming case as well, the concerns over the delisting of Didi. And so Alibaba, of course, another big loser on the day.
Taylor Riggs, thank you. Twitter, a name we need to talk about as well. Small move to the downside on Twitter. Apollo enters the building, maybe to support Elon Musk, maybe to enter the building with its own bid. Let's get to the West Coast and catch up with Ed Ludlow. Morning, Ed.
Yeah, good morning, John. Bloomberg sources saying that Apollo will get in on the act, right, either as a supporting act alongside the Musk bid or another bid, potentially Thoma Bravo, for example, whose hat's already in the ring, could be in the form of credit or preferred equity. And down 2 percentage points on Twitter on Tuesday, the 8% gain we saw Monday was the biggest jump since April 4th, which is, of course, when Musk first disclosed his stake. And speaking to folks at the company, speaking to investors, it seems now that we're moving in a direction where the poison pill's been instituted by Twitter, confirmed in a regulatory filing Monday. The outcome, whatever it may be, because we're still in the game, is more favorable to investors. That seems to be the direction of travel that we're now moving in. It's interesting because it could be Musk that does this, but on the table now seems to be this idea that it could be any number of combinations of a consortium of private equity if Musk is not successful. I took a look on the Bloomberg, John, FA Go, and looked at some of the financials. And what's really interesting here is that Twitter's revenue is due to grow, top-line growth of around 17% this year, jumping to 22% this year. But I logged on this morning and I saw Bloomberg Intelligence with a really smart note saying, why would Twitter hang around on any offer? Why don't they just do it, go private, because it would unlock value in terms of product innovation and ultimately growth? We'll wait and see on that one. But ultimately, the stock is down 2%, John. It's hard to know if this is just leveling out. I would say we got a disclosure 13F from ARK that they, for the first time in 5 quarters, cut their stake in Twitter.
I won't get too excited about the move this morning. One thing that gets my attention, Ed, is that you also cover Tesla. That's gone quiet. What are investors saying about that story, given what's developing with Twitter?
Yeah, interesting. I mean, back when this all started to unfold and there was some selling on Tesla stock, the idea was that Musk might have to sell some of his shares to fund a deal for Twitter. But alongside that, we're super focused on Shanghai. There are media reports, local reports that the factory in Shanghai has restarted after that shutdown where the government was conducting phased testing. Shanghai is just so critically important, and with earnings around the corner Wednesday night, we want to know what the impact of that, how unsettling or derailing was the shutdown of that plant in the bigger picture of this year.
Hey Ed, great coverage as always, buddy. Good reporting. Ed Ludlow there on the West Coast on the Twitter and Tesla story. Tesla just about positive on the day, up a third of 1%. Ed mentioned Shanghai. Early this morning, Bank of America, overnight in fact, cut their outlook on China GDP from 4.8% to 4.2%. That was their base case. The bearish scenario, they put a 3 handle on Chinese GDP at 3.5%. That's their bearish scenario, something to think about given the disruptions from COVID controls and zero COVID, which B of A thinks is going to be the policy effort from the Chinese government all the way through to the Chinese People's Congress later on this fall. So look out for that, and look out for more downgrades too. B of A not alone in doing so. The story for after the close is, of course, Netflix. Year to date, it has been absolutely battered by more than 40%, down 44% year to date in 2022. Wells Fargo calling it a, quote, wait-and-see quarter with investors likely resetting afterwards. Kaylee Lyons taking a look for more. Hey, Kaylee.
Hey, John. Yeah, it's been absolutely brutal for Netflix going into this print. And once again, it's going to be all about the subscriber story. 2.5 million net additions are expected in the first quarter. But what does the outlook look like? And how has the recent price hike, as well as the pulling out, the suspension of services in the Russian market, impacted the business? That will be the question we look for answers to later on this afternoon. Of course, Netflix really just the first of the big tech companies to report. Tesla's due tomorrow, then Microsoft, Alphabet, Meta, Apple, Amazon, all throughout the duration of next week. And as for how sentiment is shaping up ahead of those reports, once again, we've been heading south for big tech. You saw how painful it's been to, for Netflix, but for the broader NASDAQ 100, which houses a lot of these large cap tech stocks, it had a really rough start to the year, falling 20% from January 1 to mid-March, then staged an impressive rally through the end of March. And once again, the direction is lower. We have cut those year-to-date losses and now down about 16% on the year. So it's looking like that rally we saw at the tail end of last month may have been a bit of a false start. And of course, the thing weighing on a lot of these stocks, in part, is just higher yields. Higher borrowing costs put pressure on stocks that command higher multiples, which many of these players do. But there's other factors here as well, including consumer confidence and the issue of discretionary spending. If you are facing inflationary pressures at the gas pump, at the grocery store, are you going to want to spend on Netflix and other streaming subscriptions or buy that new iPhone? Speaking of iPhones and production issues, supply chains also a big factor here, as well as the broader issue of attracting and retaining talent. All of these headwinds that tech companies are facing, John, we'll see how far they can push through them when we get these reports in the next couple of weeks.
Just quickly on Netflix, have you cancelled any subscriptions whatsoever, Katie Lyons, in the last couple of months?
I canceled Hulu.
There we go.
Yeah.
The full package.
The
because
full
my
package.
Hulu package costs a fortune.
I never had the full package to begin with, but I got over Handmaid's Tale and I was like, eh.
Nothing left. Katie Lyons, thank you. Not alone. If you look to the United Kingdom, the FT reporting earlier this week the following, that we have seen British households cancel video subscriptions in record numbers as they curb non-essential spending to cope with the cost of living squeeze, reinforcing concerns that a pandemic-fueled boom in streaming is over. Now, what's interesting to me about this story, and this is backed up by Cantor Research, by the way, is that we always talk about these names as if they're just secular growth stories, that they're immune from what happens with the economy. But this is an economic story now. Are people going to cut back from the 25 streaming subscriptions that I know many of you have got? Of course, I'm talking about myself, given what's happening with prices recently. Perhaps. Stuart Kaiser of UBS joins us now. Stu, you think that maybe there's an opportunity here in technology. The risk-reward has improved. Why?
Hey, good morning, Jonathan. Yeah, that is our view. You know, essentially, as Taylor mentioned, a lot of these tech stocks have been really punished by the move higher in yields and by the shift more hawkish in Fed pricing. You know, our view is that inflation probably peaked in the most recent print. And as that inflation comes under pressure, it should kind of take, you know, some of the sting out of hawkish pricing going forward, and that collectively should read positively for tech. I mean, if you think about this, it's a pretty clear feedback loop from high inflation to more hawkish policy to investors being concerned about the growth outlook. And we do think that we're sort of past the max pressure point from that.
Just to work through this with you, Stu, so we're working through this pivot from inflation concerns to growth concerns. I've got all that. In the meantime, what we've seen is a pretty defensive bias in this equity market with cyclicals underperforming, and we've seen the more defensive parts of the market outperforming. Are you saying there's an even bigger reason then to stay away from the cyclical parts of this equity market? There's no reason to lean in there whatsoever?
No, I mean, I think those calls are related, Jonathan. I think, essentially what's happened is that the Fed has gotten hawkish enough that people have started to get worried that they're going to over-tighten and materially slow U.S. growth. And I think that's ultimately what's caused cyclicals to underperform. You mentioned earlier utilities versus banks. I think one of the reasons utilities has been able to weather the move higher in yields is because folks are worried about growth and they're trying to hide in a more defensive part of the market, whereas financials have been on the other side of that coin. So I think these things are pretty related, just in the sense that the Fed pricing got to a point where people started to question the growth outlook. And as inflation comes off, that pressure should ease. That should open the door for, I think, cyclicals to recover a bit. And from our perspective, tech has been the area of the market most punished by that combination of higher yields and inflation. And we do think that the risk reward is kind of improving there.
Stu, where do the banks fit in?
Look, to your point, the banks theoretically should be doing much better in a higher rates environment. I think the problem is that the growth outlook has been hit as well, and there is a cyclical aspect, particularly from a domestic perspective for banks. And I think that's probably why they've underperformed. If you go back to earlier in the year when rates were rising, banks were doing just fine. So I think banks were able to track the move higher in yields up until the yields reached a level where it became a serious headwind for growth. And then you saw banks start to underperform. So if we do get in a situation where yields are, higher than they were, 6 months ago, but this recession risk discussion eases a bit, I think that does allow, hopefully, financials to recover a bit on a relative basis.
Let's just finish on tech quickly. Best way of expressing that trade, Stuart, for you and the team, what is it?
We're keeping things pretty simple. We like July call options on the NASDAQ 100 as sort of an opening bid here. Admittedly, we could be a little bit early. Obviously, NASDAQ's been under a little bit of pressure this week, but we do think you're going to want to start there. The other part of the tech space, which has underperformed significantly, has been semis. Because of the supply disruptions, I think that one is kind of a little bit fraught right now in terms of stepping into it. So, we're keeping a really big picture and staying with NASDAQ 100. If you wanted to get aggressive, you'd start to, toy around with that profitless tech part. I think, to me, that's a step too far at this stage, and we would just stay with NASDAQ 100.
Do you need the long end of the Treasury market to settle down for this to work?
I don't think you need it to fall, but I do think you need, rates volatility to calm down and the rapid increase we've seen in yields to kind of calm down a little bit as well. Bond volatility has been a little bit of a bugaboo for equity markets for the last, 4 to 6 weeks, if not longer. So, bare minimum, I think you want to see bond volatility come in and at least rates stabilize a little bit so that, so investors can build a base case. Frankly, It's been hard to build a base case these days because your base case is useless, the next week. So if it just calms down a bit, I think that would be incrementally positive.
Hey, Stu, it's been a struggle, that's for sure, in the bond market. Stuart Kaiser there of UBS. We closed out the month of March looking at yield curve inversion. Then all this steepness kicked in a massive way. Your 10 years up another 6 basis points today. Just a little bit of flatness actually today with the front end driving higher by 9 basis points to about 254. Taylor Riggs writes in, Hulu. Taylor, nothing left. Kardashians are on Hulu, you crazy people. Do you think that makes a difference, Taylor?
You can't unsubscribe to Hulu right when they get the Kardashians, John.
Do you think that's going to be the game changer for Hulu? I'm not going to lie. I came back from vacation and I watched episode 1.
Told you. I knew
Just
it.
for you. Kendall wasn't in episode 1, though.
Oh, John, look at you
for
go.
episode 2. Just, you're proud of me. Taylor Riggs, thank you. Coming up, a US judge overturning the mask mandate on planes.
So this is obviously a disappointing decision. We're continuing to recommend people wear masks.
The control room can't believe it. The conversation is up next.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
CDC recommended continuing the order for additional time, 2 weeks, to be able to assess the latest science in keeping with its responsibility to protect the American people. So this is obviously a disappointing decision. We're continuing to recommend people wear masks.
The US is shedding its masking mandate for public transportation. The TSA running in a statement the following. Today's court decision means CDC's public transportation masking order is not in effect at this time. Therefore, TSA will not enforce the security directives requiring mask use on public transportation. Joe Matthew joins us now from DC. Now, Joe, you and I went back and forth on this morning. On the record, they're disappointed. I just wonder how disappointed the administration actually is, given they had another decision to make on this in just a couple of weeks' time anyway.
Well, that's true. A lot of people don't realize, Jonathan, this was only a 2-week extension by the CDC, and the airlines had already reached out to the White House earlier this month asking them to bring the mandate down. The White House disappointed with that moment from a briefing late yesterday. Jen Psaki had only known about it for a short time, and the line from the White House is, stand by for news. This is going to the Department of Justice now to review the decision, and we'll find out if they plan to take any legal action. But to your point, some are suggesting this could be a gift to the administration and to Democrats at large in a midterm election season when these mandates are very unpopular with about half the country, and it's something that they may not have to talk about the rest of the year.
Delta Airlines said this in a statement. Here it is, Joe, I'll read it. We are relieved to see the U.S. mask mandate lift to facilitate global travel as COVID-19 has transitioned to an ordinary seasonal virus. Do you think the administration is ready to treat it the same way?
I'm not sure that's the language that we're going to be hearing, 24 hours after the CDC says they still recommend masking. I'll be curious to see where we are, for instance, though, by the end of the summer and what the language sounds like there. We should note Uber was quick to follow, Amtrak too. Jonathan, I was on an international flight and on an Amtrak train, both in the last week. The enforcement on Amtrak was far more severe than what I experienced in the air. So everyone is going to be potentially living in a brave new world here.
Joe, looking forward to the program a little bit later. Sam Don, Bloomberg Radio, weekdays at 5 p.m. I don't know about your experience flying over the last couple of years. My problem hasn't been the mask mandate. Taylor Riggs, my problem has been the enforcement of the mask mandate. The relationship between customers and airlines right now has been absolutely dreadful. And the customer experience, I think in some cases, has been absolutely shocking. And I hope we go some way to taking the burden off the airlines and getting back just to a traditional customer service provider relationship that has been sorely lacking over the last couple of years.
And John, that's really where we're going to try to fold in the exuberance of the headlines with the fundamentals of the company, right? When you think about the customer experience and, of course, the share price reaction, where you get that immediate exuberance here, you, of course, have airlines a little bit higher on the day. You already talked about sort of the big six, some of the differences in the statements coming out between the two. But, of course, sort of that long-term picture, despite the positive news, at least for today, has been a big hole to climb out of. I mean, our Dan Curtis, producer, was doing some big analysis going back to 2019, still one of the underperformers, still one of the only sectors in the negative, and still down about 25% from some of those 2019 levels. So really an industry that's been hit so hard and really trying to climb its way out of. I think sort of that bigger question, John, and you know this from a lot of your international travel as well, is that international travel has been hit a lot harder as well. And when you think about profitability, clearly international has been much more profitable than some of the domestic flights. Here, this chart here looks at revenue, passenger miles in the last quarter, breaking it down from domestic, and you just see the hole that international is in. And that here is the conundrum as we think about, does removing those masks sort of help the travel industry rebound?
Taylor, if we can just recap the earnings we have had in the travel industry from the airlines. In the last week, we had Delta. The numbers from Delta were really encouraging. You're going to be looking at Netflix after the close as well. Run through what you're getting from the earnings at the moment and the forward look that I think we're all sort of wrestling for. And that's what we started this hour with.
Yeah, you know, I guess we could go back to the classic age-old theme of inflation. When you think about Netflix, it's all about pricing and the pricing power. Does that create churn? Are you going to be canceling Netflix like you did Hulu? Maybe not, right? When you think about Porter's Five Forces, who is the pricing power? Netflix does. That, though, of course, will be one to watch. When you talked about airlines, John, with Delta, it was all about some of the record sales, right? So maybe not selling the number of tickets, but they're having that pricing power and being able to pass on those costs to the consumer. So I guess still for me, inflation very much front and center.
Taylor Riggs, thank you very much. BofA actually came up with their sum of earnings so far, and so far, I stress so far, because we've got so much more still to come. I'm looking forward to Apple on the 28th in about 9 days or so. BofA picked out two companies, Delta one. I'll read the quote. Delta issued impressive 2Q22 guidance, supported by a strong recovery in both corporate and leisure travel. They picked out Fastenal as well, one of the industrial companies here stateside, also beating on both sales and EPS with increased demand and pricing outpacing cost inflation. Wall Street took the story in the last week on the earnings front. We saw the underperformance of the banks year to date. We saw it last week too. Bit of a bump in the last 24 hours. But if you take those two companies, there is a decent picture out there for Main Street that maybe we weren't anticipating for the likes of the airlines, given what's happening with inflation and these big questions about where on the discretionary spend consumers will pull back, given that CPI is at 8.5%, gas prices and food are through the roof. From New York, up next, we'll get to the trading diary and run you through the events through the rest of this week, with the main event coming on Thursday with Chairman Powell and President Lagarde of the Federal Reserve and ECB, respectively, sitting down for a panel in Washington, D.C. Looking forward to that. From New York, this is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
On a sector basis, the winner of the year, the loser of the session, just about in negative territory, energy equities. Everything else doing okay. The S&P up 0.6%, the Nasdaq 100 up 0.4%. Netflix earnings, as we've said repeatedly, coming after the close a little bit later. In the bond market, some big moves to talk about, stateside and in Europe too, on both sides of the Atlantic. The 10-year Treasury up 6 basis points, 291. A German 10-year up 10 basis points, 94 basis points. A German 10-year higher, yield up. The US 10-year yield higher, up. In Japan, nothing's happening. All month so far, we're up just 2 basis points, and that's why you've got that renewed yen weakness again. Dollar yen, for 13 straight days, we've had yen weakness, a record losing streak for the Japanese currency. That's the price action. Let's get you the trading diary. President Biden discussing infrastructure at 2:45 Eastern Time. We get a host of Fed speak on deck with President Evans and Kashgari later today. The earnings after the close, Netflix, followed by Tesla and United on Wednesday. Delta really tidy last week. Can we get a repeat of that act from United Airlines in the next 24 hours? Then on Thursday, it's the big one. You've got a panel between Chair Powell and President Lagarde of the Federal Reserve and ECB, respectively. Looking forward to that. We round it out with some data, with initial jobless claims coming up on Thursday morning. So from New York, that does it for me. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employer's winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war. So the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Vintergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Vintergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, and language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings. As well as describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW, and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students so that, whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.